Hi everybody, just bear with me a moment. I'm just going to share my desktop. Brilliant. It seems like everything is going well. Everyone can see everything, which is great. Let's get going. Now, you should be able to see Euro-dollar chart. It's quite a wide chart because I've recently changed my monitors. But let's move forward. I mean, there's a few things I want to just discuss first off the bat, really. There's been a lot of there was a lot of potential fundamental drivers over the end of last week and over the weekend, which included the EU summit, of course, but also the Spanish regional elections. Well, as it turned out, they didn't really change the overall direction. They didn't really tell us anything new, and they don't really change the landscape that we're currently in. So what we're we're essentially range bound. That's kind of the biggest deal. Actually, just before we get going, I'd just like anyone to write me any questions on the Q&A box, please. Write your questions in the Q&A box if you have any. I'm very happy to take them. Sorry, I forgot to mention that at the top. Basically, if you write them in the Q&A box rather than in the chat box, then that's easier for me to see them, and hopefully I'll answer them earlier on. But basically, we haven't, just going back to what I was talking about earlier, the landscape hasn't really changed in the last week, but it hasn't really changed in the last month, if anything. We're pretty much range bound. There's a few interesting things and I'll go through them, but we've been testing some very important levels in certain asset classes and not been able to get over them. Resistance really has been key, but then we've been quite supported on the downside. And now that's across asset classes, not just in euro-dollar. This week could be quite interesting. Not only do we have the first batch of Q4 data for China, for October data really, for China and Europe, we also have the FOMC meeting which concludes tomorrow, and of course we've got that Bank of Canada meeting today, which I will talk about in a bit of detail later on, because there's quite an interesting development going on there in the market. But let's turn our attentions first of all to euro-dollar. As you can see, this is the short-term chart. This is the hourly chart. Goes all the way back to the beginning of, or the first week of this month, where we had been as low as 128.50, got as high as kind of 131.50 last week. Since then, we've really kind of been dwindling lower. But as you can see, just even looking at a fairly short-term chart, we're really in the middle of that range. So yes, we've come off. Yes, we've fallen through 130.50 in the last couple of trading sessions. But what we haven't done is really collapse outright. So where could we go from here? That's what you all want to know. I mean, from a technical perspective, it still looks to me like there's a bit of, like the rally in euro-dollar is incomplete, that people are very much willing to buy the dips on euro-dollar. And the reason why I say that is, or the reason why I think that is that we have essentially got, from a fundamental perspective, I think people are willing to buy the dips in euro-dollar in case, just on the off chance that there's going to be some massive action taken by the European authorities to sort this crisis out. And for example, what that could mean is say something like Spain applies for a bailout, or Spain applies for a line of credit, and it triggers the OMT program. The market seems to me to be very hesitant to sell euros too far in case something in the fundamental picture changes, which gives euro another kind of leg higher. Basically, since we've got, now let's just turn to the daily chart quickly. Since July, when we went all the way down, when we got all the way down, but kind of well below 125, almost looked like we were going to hit those 2010 lows, back at 120. Since the ECB came in and said they were going to step in, they were going to support the euro, they're not going to let the eurozone fail. Well, we've had this kind of phenomenon which you usually see with the Federal Reserve, which is no one is going to sell the ECB. No one's going to fight the ECB. And that has been one of the key things. So as you can see, you can really see it here. Euro-dollar is still very much an uptrend. In fact, let me just draw that line. Bear with me one moment. And this is the longer term chart, as you can see, in a really nice uptrend. In fact, if anything, that 129.90 level is going to be the key support zone to watch out for. And as you can see, a bit of a flat top going on here. Oh, thereabouts, sorry. Let me just change my pattern here. Let me just change my... There we go. As you can see here, this kind of 131.50 to 70 level is a big resistance zone. But right now, the kind of pattern that we're in at the moment seems to me to still be a bit of an ascending triangle. And what you know when you get an ascending triangle, basically it's flat on the top, but the bottom, so we're not going any higher, for sure, we know that. But the bottoms, we're still getting higher lows, and that suggests that the uptrend is still very much in place. So really, until we break below 129.80, we're still fairly constructive that Eurodollar can actually bounce higher from here. Obviously, that 131.75 is absolutely pivotal. But if we do get above there, then all of a sudden people will start tackling or start targeting this 132.70 level ahead of 135. So there is, right now the technical picture isn't saying to me that we are in a prolonged downtrend or we are going to retest 125. For those of you who read our... Oh, brilliant. Some people are asking questions, which is fantastic. Please can you ask them in the Q&A box, not the chat box. You can get that just at the top if you go to this Q&A. In fact, maybe FX Street admin could just write down the instructions for how to put questions in the Q&A. But I will take this one in the chat box. It said, someone said, Solomon has said that all last week's EU news turned out to be a damp squib, and that's completely true. I mean, that was one of my headlines for one of my reports last week, is that the EU summit turned out to be a damp squib. Completely right. Very perceptive of you to get that. People have, in the past, we've seen EU summits cause massive bounce of volatility in the markets. Not so anymore, and we think it's because the ECB has come in, they've thrown all their resources at keeping the Eurozone safe, keeping the euro essentially intact, and that has depressed volatility, and that is why we're seeing periods like this whereby, yeah, sure, we're moderating a little bit, yes, we've backed away, we've gone from kind of below 131.50 to below 130.50, but we're not really on a downtrend, and you can really see that. You may not see that necessarily in the very short-term charts for those really short-term intraday traders. But if you've got a slightly longer term time frame over kind of days or weeks, then we are technically we could still rally from here. Again, we think there's going to be an awful lot of buying interest around just where the bottom of this ascending triangle, the support level on this ascending triangle is, which is around about that 129.80 to 90 level. Big area of support there. We could see a lot of buying interest, as I said, and there does seem to be a lot of resting support, so people want to go and buy the euro. They just maybe are looking to do it at a slightly better level. Now, obviously, that 131.75 is a huge level to get above, and actually, if anything, I think the thing that will get us above that is potentially a Spanish bailout or the triggering of the OMT, something like that. If that happens, then we could get kind of above, maybe even retest 135. But the one thing that I would say, there are a couple, for those of you who are Euro bears, Euro bulls right now, there's a couple of things to just watch out for in the near term. Obviously, the PMI data tomorrow is going to be pivotal, and that's released 9 o'clock London time. Basically, why it's so important, because primarily its importance is derived from the fact that weak economic data, even with the OMT program coming out of the ECB can't help fuel growth, which essentially growth will be the only long-term solution to the Eurozone sovereign debt crisis. So yes, the ECB can stabilize it in the short term and bring down bond yields, but it cannot stimulate growth. And that's going to be the key thing, really. So do watch out for that. We could see a bit of selling weakness if we get some negative surprises in those PMIs. However, we've had negative PMIs for so long now that the risk is actually that we get slightly better than expected, and if we do that, that could really see us turn around. So really see us kind of bounce back towards that kind of those highs from last week and also from mid-September. Okay, I spent a lot of time in euro dollar, but I just wanted to show you that yes, we might be weaker in the very short term, but really, the rally to us is still incomplete and could still go higher from here. Now, when we talk about euro, I've spent a lot of time talking about central banks, about how they've been able to prop things up, how they've been able to keep volatility depressed. Well, when you talk about central banks, you've got to really talk about gold as well. And gold has been fascinating. This is the gold daily chart. As you can see, what an amazing, really lovely rally higher. We moved sideways really for the bulk of May, June, July, and then the minute Draghi started speaking, we shot up. However, there is a bit of a concern. And as you can see here, the big concern is once, twice, 3 times, we have not been able to get over 1,800 in the last 12 months. Now, that is significant. The fact that we've rejected this level 3 times is making me fairly bearish on gold. Obviously, number one, the fact we rejected it suggests 1,800 is an enormous level. It also suggests that people aren't thinking about gold in terms of pushing it above 1,800. They're thinking about it as a take-profit level. They're getting nervous around that big level, and that's going to make it incredibly difficult to get over again. Right now, gold, it's come off quite sharply. We've gone from kind of nearish 1,800 all the way down to now we're below 1,720. Some very good support, as you can see, kind of 1690 and then 1680. That's your 200 and 100-day moving averages. They should act as very, very good support. And then below there, obviously, you get this 1630 level, which was the top of the range that we saw back in, we saw over that summer, over that period where we moved sideways. However, some people are even targeting this 1535 level, so the low of that range, which we really got into in May. Now, one thing I just want to tell you, or I just want to show you, we're just going to extend our minds back to the early summer months. Oh, let me just do that. And so even though we range traded in gold, we did have a bit of a bullish bias, because really, even though our gains were capped, our losses were capped as well, and we kept making higher lows, which is obviously supports a break to the upside. However, now that we that was a great almost kind of warning sign that people were gearing up to break to the upside on a technical basis, and then obviously the fundamental basis really saw us shoot higher. The other thing that I would point out, though, however, if in this environment whereby people lose faith in the ECB, we remain in a deflationary environment because growth is so low, then we could actually see gold go back into this range, which would make 1535 quite a 1535, the next key support level of note. So there could be a way down, or there could be further to decline from here. I mean, to the tune of roughly kind of $200, which is not small change. What could turn this around? Well, potentially what could turn it around is the ECB buying Spanish bond deals. Some people may fear that's inflationary, even though we actually doubt that will be inflationary. And the main reason why is that, or the main reason why we think that is the case, is because the ECB has been very clear. They're going to sterilize bond purchases, and they are also going to not only are they going to sterilize bond purchases, but we've had numerous ECB members come out and say there is nothing inflationary in this. So that's one thing. I mean, the other thing is that for example, I think if anything, what could be the trigger to turn gold around, maybe a very dovish Federal Reserve tomorrow, whereby they actually almost hint that QE is going to go on forever. We don't necessarily think that's going to happen because the fundamental backdrop isn't there. If anything, the risk is that the FOMC statement, which is released tomorrow evening at 7:15 London time, actually causes another leg lower in gold. So we could potentially get to maybe that 1650 level, 1675 level, which is that 200-day moving average, because potentially, what we're looking for in this statement, QE is already baked in to the market. What we're looking for instead has been what we're looking for instead. What we're looking for instead is a change in, maybe a subtle change in the FOMC's view on the economy. And if anything, that view should be slightly more positive based on the economic data. However, they may choose to be more neutral because obviously they only just announced QE, so they can't turn around and say, well, actually, you know what, the economy's fine, it's great. If anything, there's going to be more of a, we think it's going to be more of a neutral statement. So gold could be a bit volatile around here, but overall, we don't think. We don't see, gold. We don't see anything at the moment being able to prop gold up. That's for sure, because we see deleveraging. We see central banks potentially being less aggressive, and we don't see inflation. That's the key thing here. Someone's just said the dollar's been shooting up as expected. Would that shoot up gold? Well, traditionally, when gold rises, we see gold. Sorry, when the dollar rises, we see gold come off purely because. Gold is priced in dollars, or this gold is priced in dollars. You can trade gold against many currencies, but for now we're looking at gold priced in dollars. So that can, obviously, when the dollar is stronger, it takes less of it to buy gold. However, that is only one of the components into the gold price. There's plenty of others. I mean, it's seen as an inflation hedge. There can be technical issues. There can be people unwinding of positions. There can be overall risk of the overall risk environment, etc. So there can be multiple things, and it's not just the dollar, even though that does have quite a strong relationship with gold. So yes, I mean, the dollar has been, fairly strong against things like the yen, but it hasn't been strong on a broad-based basis. Just bear with me one moment. I'll just show you here. You should now just be able to see my Bloomberg chart. Let's just bring this up. As you can see, I mean, the dollar index, which is the dollar against its largest trading partners, has really been flatlining. It hasn't been fantastic, which again doesn't necessarily support, the gold. It's been flatlining. It hasn't been shooting higher. Oh, let me just show you that again. Great, you can see them together really. It's been flatlining as gold has been falling. Usually what you'd expect, gold to fall and then the dollar to move higher, but that hasn't been the case this time around. So as I said, it doesn't always work that way. If people could ask questions that they want me to answer in the Q&A section, Solomon has done that, so well done, thank you for that. And Solomon said a really interesting thing. He said, as a small trader, I find it hard to trade gold. It's very high risk. Euro-dollar is my bread and butter. I mean, that is true. Gold, as you probably know, those of you who trade it, it's not unusual. Gold can move $50, $70, $100 in a day. And because it's slightly more volatile than say, currency pairs, you do have to put up higher margins usually. Your brokers will normally request that. Yes, it can be more difficult to trade gold if you are a smaller trader. Likewise, it moves very quickly and in large increments, so you need to be able to be protected. Make sure you have enough money in your account. Make sure you've got your stop losses in correct places, etc., to stay in the trade. The next thing is that it's kind of worth kind of pointing out is the next thing that's worth pointing out is as someone said, euro-dollar is my bread and butter. Euro-dollar doesn't trade directly with gold at all. It's a completely different trade. However, some people would rather choose to stick to a major currency pair than to choose a commodity. However, gold is interesting, I think, and even if you don't trade it, I think it's always worth looking at it. And the reason why is that gold is it can be a lead market indicator. Now, my big concern, and this is what I've mentioned to a few people, is that I'm going to be looking at gold very, very closely, because if it continues to decline, to me, it could suggest, potentially a clearing out of, it could move. Usually what you see is commodities move first, or interest rates move first, then commodities, then stocks. So if we see a push higher in interest rates, that should weigh on commodity prices like gold, and then that should weigh on stock prices. That's how it technically works. And since stock prices have been hitting resistance levels but not been really able to extend gains, there is some concern now that they may fall back. So I'm going to be watching gold very, very closely. Okay, guys, now I mentioned something that I wanted to talk to you about, which is CAD. Bank of Canada announces interest rates today at 2 o'clock London time, which is 9 o'clock US time. And basically, over the last, as you can see, from kind of the June all the way down to mid-September, the CAD was on a rip higher. I mean, it was doing so well against dollar CAD. As you can see, dollar CAD just collapsed pretty much from 105 all the way down below 97. But and that was based on a couple of things. Number one, the Canadian Central Bank being quite hawkish relative to other central banks, and secondly, it got to the point whereby the market expected the Bank of Canada to be the first of the major central banks to actually start hiking rates in the first quarter of 2013. Well, along comes QE3 from the Federal Reserve. Canada, it's got to have competitive exports because US is its largest trading partner, and all of a sudden the Bank of Canada governor is backtracking his words, sounding a lot more dovish than expected, and we've actually seen the CAD give back some recent gains. Now, obviously, as you can see, it's jumped from kind of 97, dollar CAD has jumped from 97 or just below there, all the way, it's getting very close to parity now. It's at 99.5, that or thereabouts. That is that's had a big move higher. So we've got this Bank of Canada meeting today. I would say that really to get us above parity, we need to see a huge amount of dovishness and potentially even a surprise rate cut to get us above there, because I think so much of the dovishness is actually priced in. If anything, I think the risk is that the Bank of Canada isn't as dovish as some expect. Now, let's just take a look at this chart. I'm going to show you another chart as well. Here we go, 99.80. We've got the 200-day moving average in dollar CAD. That is going to be enormous resistance ahead of that key parity level, that key 1 level in this cross. If we, that could really thwart the bulls, especially if the Bank of Canada isn't as dovish as some expect today. Now, the other thing I want to show you is the Ichimoku cloud, because not only is it the 200-day moving average, but this 99, between kind of 99.50 and 99.80, 99.50 being the top of the daily Ichimoku cloud, that is a massive, massive support zone. So resistance zone, sorry. So yes, we're kind of above it at the moment. We've kind of pushed our heads above the top of the Ichimoku cloud, but then we get that 99.80 level to really contend with. So for me, that could be enough, especially if Carney at the Bank of Canada does actually surprise to the downside. That could be enough to really cause dollar CAD to turn around, and we could get back to that 99. Back to 99 is going to be a really key support level, and then 98.25, 98.65, which is the key, which is the Tenkan line on the daily Ichimoku cloud. That could also act as good interim support. But we could be on a bit of a rip lower. Obviously, we've got this kind of congestion zone here. Let me just get back to it, around about the 97.60. So if we get a sharp sell-off, then we could there's a lot of places to find support. So there is a lot of support on the way down. I wouldn't necessarily say that we are in for kind of a decline all the way back to maybe even all the way back there. But I would say that the risk is now that Carney actually isn't as dovish as some expect, because the market has moved before he's spoken. Always very eager, isn't it? And because of that, we could potentially be at risk. So someone just said dollar yen moved up last week as you predicted. I gave you 9 out of 10. Well, thank you very much for doing that. Let's take a quick look at dollar yen. As I said, with just one final word on the dollar CAD, do watch out for that, because this level is so huge it could really thwart the bulls. Now may not be the best time to get into it. If you are certain that, or if you feel that dollar's going to outperform the Canadian dollar, don't buy on dips, I would say, not right now. Let's take a look at dollar yen, because obviously we have had a very big move in dollar yen. As you can see here, really shot higher. In fact, I'm going to just change my chart. Just bear with me one moment. I'm going to look at this chart, because I prefer looking at Ichimokus when I trade yen. And as you can see here, this time last week, I think we were just hovering just below the top of the Ichimoku cloud. Well, now we shot through that level. The top of the cloud now is 78.5, shot through there with barely even giving breath. And yet again, but however, we are being thwarted at this 80 mark. Now that is very normal, and the reason why I say that is because it is normal, because it's a huge technical level. For us, though, to see move higher, we may have to wait until we get the FOMC outcome tomorrow. If they're very dovish, it's going to be hard to see how the dollar can continue to sustain these rallies. Now, we still think it's going to be fairly supported. Obviously, 78.5 now is a massive support level, but also 79, which is the Tenkan line on the Ichimoku cloud. That's also going to act as very good support. However, for us to see an extension above 80, what we may need to see is wait till October 30th, which is when the Bank of Japan meets. There's a huge expectation now that they're going to throw everything, including the kitchen sink, at their QE program, so their asset purchase program, which they call their APP over here, and in the US we call it QE. But if they do like something huge, like 20 trillion yen, remember a couple of months ago they did 10 trillion yen increase. So if they did 20 trillion yen, they'd be doubling that, and hopefully doubling the impact. There's not much, you've got to feel sorry for the Bank of Japan, really. There's not much they can do apart from try and weaken the yen. So we think they're gonna try and hopefully boost the economy that way. And if they do that, if they do take aggressive action at their 30th of October meeting, so that's next week, we could see dollar yen really jump up, potentially get to that kind of 81.75 level, maybe even then head towards 82. The other thing I want to show you, though, is 10-year government bond yields. As you know, those of you who have been following my webinars for a while, we tend to have dollar yen tends to move very, very closely with 10-year Treasury bond yields. It's just the biggest. It's a pair that's very sensitive to changes in interest rate differentials. As you can see, 10-year Treasury bond yields, they are being thwarted around about this 1.8 level. We've been kind of bouncing around here. Now, obviously, the range is really. Let me just draw a few lines here. The range is really narrowed on this, as you can see. And usually the ranges don't narrow that much. What we see instead is kind of a big what we tend to see is if the range narrows, then it suggests, or it preempts, if you like, a sharp move up to the upside. So one thing I would say is, yes, we seem to be flatlining at the top around about this 1.8 level, but on the downside, we are making higher lows, as you can see there. So first of all, it was 1.4, then just below 1.6, now just above 1.6. So it suggests to me that pressure is building for a breakout to the upside, but we shall have to wait and see. Obviously, the Fed will dictate that. It will be very much dependent on what the Fed do. We're going to not just this month, but also maybe in December. So we could be range bound for a while. However, we could see, if we see the Bank of Japan become extremely dovish and boost their QE in a huge material way, then that could have an impact on dollar yen. But really, it's going to be the Bank. The Federal Reserve in the US, and what happens to Treasury yields. We think that will be the key driver to see sustained gains in dollar yen. So do watch out for that. And when you trade dollar yen, always keep an eye out. I know that this yield data can be quite difficult to get hold of, but read our reports, read what's going on in the papers, to see what's going on in the credit markets in the US, because that is important, or certainly in the Treasury markets in the US. Okay, guys, that's about it from me. I'm happy to take one question if anyone has one. Someone's asked, the dollar has been much slower to rise than predicted. Do you know why? Well, it depends how you see it. I mean, there is nothing to say that, that the dollar should have risen. Obviously, there's been QE that's thwarted dollar gains. Secondly, there's been a lot of, we haven't had any massive fundamental changes to push things out of recent ranges. So what we've seen actually is, the dollar take its time. Now, it hasn't necessarily taken its time against something like dollar yen, but obviously it's kind of been, as I showed you, I'll just show you this dollar index chart here. As you can see here, dollar yen has been, the dollar index has been flatlining. It hasn't done too much. And one of the reasons for that has been QE. So that's kind of the key thing. The dollar index is a good thing to watch for overall dollar movements. But, in some ways, yeah, I mean, dollar yen, it's been thwarted, that's for sure. You're not totally wrong. But, some people had expected a rise in dollar this year, maybe because of a stronger US economy, etc. But however, the Federal Reserve has really come in and thwarted that. So it's always that kind of thing, like don't fight the Fed, and you can really see that here in dollar. It's really thwarted dollar gains. The dollar was looking really strong in July. Along comes the ECB to say that they're going to look after the euro, and you see a decline. So it's been hit by both sides, not only the European Central Bank being more proactive, but also the Federal Reserve and its QE, and that's really limiting upside. Okay, guys, it's 10:30. I better let you all go. I want to say thank you so much for everyone for joining. Please do join us next week for our. Please do join us next week for Trading Tuesdays with myself, Kathleen Brooks. And good luck trading this week. And do watch out for all of those event risks. PMIs out of Europe, GDP out of the UK. We didn't even get onto the pound, but we'll talk about that next week. It could be more interesting then. And of course, that Bank of Canada meeting today, and that FOMC meeting, which concludes tomorrow. Thank you very much.